All right, my next guest says that the flow of the Red River in the North Basin can help explain why stocks are outperforming the economy. Now, by the way, after reading his piece, I would use a Bronx Tale as an example. Now use can't leave, but again, I'm less creative. So let's bring in JPMorgan Chief Global Strategist David Kelly, because essentially, you know, you're saying the money is trapped. I mean, the way this thing works, it's sort of like this scenario here.
That's right. I mean, the Red River is so unfortunate because it flows from south to north. So when it thaws in the spring, it thaws in the south first, and all this water rushes in, but it can't get out. And so if you're living in Fargo or Great Forks, you just get flooded. And when you look at the stock market, what's happening is there are a lot of things that structurally have changed in recent decades, which is pushing money into the market, but it's very hard to get out.
Right. So then let's talk about some of the things, because you covered a lot, including inequality playing a role, you know, with this and the difference in, for instance, pre-tax income. I want to kind of add a twist to that this year, because tax refunds are going to be huge this year. Do you think some of that money will go into the stock market, helping the so-called have-nots maybe be able to participate?
Not too much. I think it will help the economy. I think a lot of this is going to go to people in households, 50,000 to 100,000, but it's really the very rich, you know, who are, you know, who have that extra money, who've been putting money into the market. But if you think about it, yes, inequality means that the top 10% of households have a lot of income, they're putting it into the market. But also, you got stock buybacks. I mean, 40 years ago, it wasn't a big deal. Last year, $1 trillion went straight from the earnings of companies straight into buying the stocks. You've got 401k plans. I mean, defined benefit plans used to be kind of even and balanced. 401k plans is all going to the stock market. And meanwhile, last thing, you got capital gains. People have got all this money in embedded capital gains. So you have to write a check to Uncle Sam immediately if you decide to sell out of this market. So again, it's easy for the money to go in. It's hard for the money to come out. And I think that's why we've had, you know, such great years in the stock market when the economy's been okay. It's been good, but it hasn't been that good.
And this is an illustration of the passive ETF flow. And again, you know, people get paid, money automatically goes into the market, which means it automatically goes into the biggest names, which automatically power the market higher. It's one heck of a virtuous cycle. The question is, when and how does this unravel?
Well, yeah, it is. And I mean, you could have, first of all, you could have changes in rules. People could, you know, attack stock buybacks. We've seen that in the past. Or you could have, if you do have a big market sell-off at some stage. We had this back in 2008. If the market sells off enough, then you don't have these big capital gains. So now you can offset it with the losses and you can rejigger things. So, you know, something could go wrong. Frankly, something always goes wrong. And so you shouldn't, you know, people feel too gloomy about the economy. I get that. But I think the stock market is too rosy relative to the economy, and I think you need to take a middle ground or a middle path if you're going to invest wisely.
Now, you do talk about the valuation of the market. You have the Shiller PE ratio, which is, you know, gone on tremendously. So, you know, from a purely fundamental, old school, you know, way, you're saying, hey, listen, be aware of this and maybe start to look at areas. You like underfunded areas, right? You're saying, hey, it's okay to start putting money in these underfunded areas.
Yeah, it is, because if you think about this century, what's really got you? It's not stuff you expected. It's stuff that you didn't expect, like 9/11 or the pandemic or the great financial crisis. And so if something like that happens, you know, you never know the hour nor the day, but you do know the location. The location of the next bear market is going to be centered on whatever is the most frothy and frenzied at the time. And people have been piling money into concentrated mega cap growth stocks. If you've got too much of your money in there, spread it out a bit.
So again, to your point, I mean, we go back to Alan Greenspan, irrational exuberance. That was what was it, 1996?
Exactly.
It took a while afterward, that, but you're saying, hey, participate in the market, but also it's okay to look for non-mega cap U.S. stocks, international and alternatives.
Exactly. You know, I think that having an appropriate asset allocation is a little bit like having home insurance. You never know when you're going to need it, but you should never feel comfortable not having it. And I think that's why people, you don't know when this thing is going to crest, but you can see some froth, you realize there's some imbalance here, so just make sure you're balanced, even if the market isn't.
Great stuff. Thanks. That's what we need to hear starting off 2026. Thanks a lot, David.
Thank you.